Guys, we are about to do the book review of book reviews. We strive to understand the economy as much as we can. You know, we're reading books, we're reading articles, watching videos, just trying to connect the dots. This book that we're reviewing gave me the most dots. It is my favorite finance book of all time. We're going to be reviewing Principles for Navigating Big Debt Crises by Ray Dalio. For those of you who don't know, Ray Dalio is the founder and chief investment officer for Bridgewater Associates. It's the largest hedge fund in the world. And I think at the beginning of the year, they were managing like $101 billion. So what we're going to do is we're going to go over the notes and we're just going to read
I thought they managed over $200 billion.
It might be. Who knows? We're going to read these notes and we're just going to elaborate on the points. And the goal is to just help you guys understand the financial system a little bit more. So, you ready?
Let's do it.
All right. So the first point, the question of whether rapid credit/debt growth is a good or bad thing hinges on what that credit produces and how the debt is repaid. Too little credit or debt growth can create as bad or worse economic problems as having too much, with the costs coming in the form of foregone opportunities. Okay, so you have credit and debt, obviously. And what he's saying right here is that too much credit could be bad, too much debt can be bad. And he's saying the cost comes in foregone opportunities. If you look at the world, all of the whole economy that we have, that we're experiencing, the jobs, you know, governments, all that stuff came from credit, right? You need to be able to issue credit so that you can pay people to get work done. And in order to issue credit, like we made a book review on the mystery of capital, you have to have like a good integrated property system so that you can prove that you own things so that you can borrow against them. And this is why third world countries are third world countries, because they don't have a good property system and it takes sometimes years to prove that you own a home or that you own a business. So if you can't prove that you own something, you can't extend credit. You can't extend credit, you don't have people getting work done. Without credit and capital, there is no labor. So obviously too much credit is bad because it can lead to inflation. He said it hinges on what the credit produce and how it's repaid. If you issue credit and that credit is used, you know, let's say it's used to hire people and those people get a job done that makes the business money, well, now that's credit put to good use because it's actually used for something versus using credit and then taking it and using it to buy assets or buy art or things like that. It doesn't go back into the economy.
Yeah, so when you look at credit, when he says that too little can be as bad as too much, so look at credit as an abstraction of the actual asset. So without the asset, you wouldn't have credit. And because we have the asset, we can to extract further value in a financial sense from that asset. That's why credit exists. And having too much credit is almost like the same environment as we were in during the pandemic when we had crazy inflation because the flow of credit just went through the roof due to fiscal stimulus. And our Federal Reserve or central bank of any country is that entity that kind of controls or heavily influences the flow of short-term credit. And so it's always a balancing act by the central bank, so that way they don't have too much credit flow or not enough credit flow, because both could be extremely horrible for the economy.
Good stuff. All right, next point. The pattern of borrowing and spending more than you make and then having to spend less than you make quickly resembles a cycle. This is as true for a national economy as it is for an individual. So I remember reading in Law of Success by Napoleon Hill, really good self-help book, definitely recommend.
About the reference, the habit of saving.
No, I'm not. No, I'm not. He was talking about in there, like, people will make money and then they'll get a raise and they'll end up being poorer than when they were making less money, because the more money we make, we want to
shift their lifestyle.
Yeah, they shift their lifestyle. We start to finance cars, houses, appliances, all kinds of things. And what he's saying here is, just like people do that, businesses do that as well. They might spend money on marketing, not track it as well, or spend it on hiring too many people. Vanity metrics.
Okay,
basically.
Let's look at Japan, right? As every country was going through an expansion, this is back in the 90s, right? The lost decade for Japan. They wanted to be part of the expansion so bad, they just racked up more debt by spending more than they brought in tax revenue for the actual country, which is why at this point now they have a debt to GDP ratio of 240%. And monetary policy is like on eggshells at all times, because look what happened last week with the Japanese carry trade unwinding. A lot of that had to do with the Japanese central bank, the Bank of Japan, them raising rates only 25 basis points. Sorry, and that is a very, very small move. It shouldn't have that much of an effect on their currency or on their economy in general. But because their debt to GDP is so high, 0.1% move in interest rates could have an exacerbated effect, just like we saw literally 1 week ago. So that's a good example of, hey, even a country, you can spend more than you're bringing in tax revenue, and that's hence the lost decade, Japan.
All right, next point. One classic warning sign that a bubble is coming is when an increasing amount of money is being borrowed to make debt service payments, which of course compounds the borrower's indebtedness. Typically, debt crises, I don't know if that's a word, occur because debt and debt service costs rise faster than incomes that are needed to service them, causing a deleveraging. A deleveraging is just the act of selling one's assets very quickly to cover the debts.
I guess not in the U.S. We've been at the brink of a sovereign debt crisis for like the past 15 years.
So you think about interest rates, right? The past few years, well, not counting the past few years where rates have been rising, but like pre-COVID and around COVID, we had extremely low interest rates, which means the cost to borrow money was really, really cheap. And people are borrowing money. So like, let's say I want to borrow $100,000 at a 10% APR. Normally what people do is they will borrow that money and then they'll use a portion of the loan to start paying off the loan. So it's like they use the loan to pay off the loan essentially. But a lot of the loans that people get, they'll have like a variable interest rate that will rise and fall with the federal funds rate. So what he's saying here is a good sign of a bubble is that once interest rates are low, people are going to borrow money. They're just going to because it's cheap. But like he was saying before, people are spending more than they make. You know, people borrow money, they start feeling like geniuses just because they got money in their account, whether it's a business or a person. And then once interest rates start to rise, the cost to cover that debt becomes more expensive, and then people have to spend less than they make because they're having to use more of that loan to cover servicing that debt.
I guess that could be any given interest rate environment, and that's why you have zombie companies that the problem becomes exacerbated, but as long as they can keep paying off their investors, they low-key can keep borrowing money. And that's what a zombie company is. They're using effectively borrowed funds to continue debt service on debt that they have on their books, because if they don't, they would completely go bankrupt. And as long as they can keep paying off their investors, the investors make money, they'll keep loaning them the money. Whether, they're just breaking even every month or they're losing money in revenue, but somehow, by cooking their books, they're not going bankrupt. So that's, literally why we have zombie companies.
All right, next point. When credit is easily available, there's an economic expansion. When it's not, it's a recession. And when the limits of debt growth relative to income growth are reached, the process works in reverse. Asset prices fall, debtors have problems servicing their debts, and investors get scared and cautious, which leads to them to sell or not roll over their loans. This in turn leads to liquidity problems, which means that people cut back on their spending. And since one person's spending is another person's income, incomes begin to go down, which makes people even less creditworthy. Investors withdraw their money from risky financial organizations, causing them to have liquidity problems.
That first sentence, when credit is easily available, it's an expansion. When it's not, it's a recession. So that sounds cut and dry, sounds black and white. So I want to kind of dig into
Ray
that.
Ray Dalio's a really black and white guy, if you haven't been able to tell. Well, he's a white guy, but you know what I mean.
That's analogous to kind of the environment that we're in right now, right? So over the past, let's say 16 months, right? Credit has been readily available in a restrictive monetary policy environment, right? And so even though we have been restrictive in nature in terms of where interest rates are and the cost of capital has been rising, people were still borrowing. So there was a demand for capital, and the supply of capital was still pretty ample, which means there was really no sign of a recession coming in the pipeline, which is part of the reason you had analysts saying that we're going to experience a soft landing. And some are still saying that because credit is still kind of readily available. At this point, it's like, I can't imagine an environment in which credit isn't readily available. And so, in my eyes, it's impossible for us to have like a depressionary environment or something like 2008 where it lasts for, weeks. It seems impossible. It seems like there's always going to be V-shaped recoveries from now on in our recessions. We only have very short-living recessions because credit is always going to be readily available, especially now with blockchain. There's always alternative forms of credit being offered. And so it's almost like that rule will no longer be the case, in that because you have credit expansion or you have easily accessible credit, it means that you're not in a recession. That won't necessarily mean that anymore, because we could have credit expansion in a recessionary environment, and that just means we're going to have a quicker recovery, hence V-shaped recovery. And so, yeah, that first statement is kind of black and white, and things are changing. You know how they say things are different this time. Well, fuck. I actually do think things are kind of different. We have too many factors, way
Super
more
different.
factors than we had when Paul Volcker was the chairman of the Federal Reserve, for example. Just think about the differences. And so, yeah, I think even with credit expansion or easily accessible credit, we could still have a recessionary environment. It'd just be a quick recovery.
So yeah, just to piggyback on what he was saying, it's not that black and white. It says when credit is easily available, it's an expansion. When it's not, it's a recession. So an important thing to remember or to know is that every single, literally every single one, every single like recession or depression that we've gone through is due to easy lending on part of the Federal Reserve. And it could be in a specific sector, right? Anytime there's a recession, it was easy to borrow money a long time before that. And you can even look at the Great Depression. After the Roaring 20s, like part of the Roaring 20s where people were financing automobiles, they were financing appliances. A lot of soldiers were coming home from the war as well. So it was just a huge amount of that, right? And after that, once they started to raise interest rates, people couldn't afford that stuff anymore. So you had foreclosures on homes, people not being able to afford their cars. I don't know if they were getting repossessed back then or what, but anytime you see a recession or a depression, you can find somewhere in the economy where it was easy to borrow money and people super took advantage. And if you guys saw the movie The Big Short, Steve Carell, he knocked on someone's door and he I forget the person's name he asked for, but he's like, "Is Lenny here?" And he was like, "That's my neighbor's dog." And they were basically trying to find out who had got the loan. The Federal Reserve made it so easy to borrow money during 2008 that you could have taken out a mortgage in your dog's name. Like they made it super easy, no red tape. And the people who
No
are working
income, no job application, ninja loans.
yeah, and the people who were working at these mortgage companies who are like issuing them, they knew it. So they're just selling it to people even if it's not in their best interest. All right, guys, moving on to the next point. In the first stage of the bubble, debts rise faster than incomes, and they produce accelerating strong asset returns and growth. This process is generally self-reinforcing because rising incomes, net worths, and asset values rise borrowers' capacities to borrow. This is because lenders determine how much they can lend on the basis of 1, the borrower's projected income and cash flows to service the debt, 2, net worth and collateral, which raises as asset prices rise, and their own capacities to lend. All of these rise together. Borrowers feel rich, so they spend more than they earn and buy assets at high prices with leverage.
So is he saying basically we are still in the early stages of some sort of bubble, or maybe we're moving into the second stage of a bubble because we've saw net worths and asset prices rise over the past few years, especially in the stock market, because most investors, let's just be real, most funds, they're piled into the Max 7, and that's been carrying the S&P since God knows how long at this point. So we have seen that, and we have seen more leverage in the system. In Web3, in DeFi, and in TradFi, we've seen more leverage as well. And we just saw maybe one of the first stages of a global deleveraging. And so maybe one of the bubbles that we're in, because shit, you can argue that we're in multiple bubble territories at this point. So one of the bubbles that are bursting at this point, we're in the second stage. If I'm basing it off of that, whether that would be probably, I don't know if we're in an AI bubble, but we shall see.
Yeah, he's basically just talking about how one thing leads to another and it cascades, and on the downside, it kind of all falls at once instead of one thing leads to another. So, like, if you watched our channel, we talk about real world assets all the time. We talk about private credit. So, it's kind of the same thing there. He said in the first stage of the bubble, debts rise faster than incomes. The reason why is because you go and take out a loan for, a few $1,000,000. If you're not Apple or something, you're probably not going to make that much money in that kind of time span. And if money is easy to borrow, you probably think, oh, I'll just pay it off. I'll just keep paying it off, or, I'll just keep kicking the can down the road. So, and he was saying that what borrowers base their lending criteria off of: collateral, how much money they have to service the debt. If they took out loans before that, they know they have money to service it. So it's just like if you look at private credit, in crypto, it's hard to get an under collateralized loan. It's all over collateralized loans. It's the pawn shop model. Like if I want to pawn my phone and get some money, let's say my phone's worth 100, they're gonna offer me 50, so that if I don't pay it back, they can have something to sell and still make some money. Well, in this scenario, if you're trying to borrow something, like let's say crypto starts to go into a bull market and their balance sheet rises, right? That's going to make them more credit worthy. And that's also going to make the private credit protocols appetite for risk increase because their balance sheet is rising too. So they're more likely to borrow. Boom, boom, boom. Everyone's happy. And then once one of the big lenders, I forget the name of the company that Gemini was loaning money to. Like it's a few lenders in crypto. And once something happens to one of them, everything start to like ball up and kind of cascade at the same time. And then once you throw leverage on top of that, it just makes everything that much more irresponsible.
Yeah, leverage a turn a 1% loss to a 4% loss. So if you extrapolate that out to 10, that's equals 40%, 100 to 40, you get what I'm saying.
All right, next point. Okay, we kind of touched on this point. He says, quite often economic lending and the bubble occur because of implicit or explicit government guarantees that encourage institutions to lend recklessly.
So yeah, that point's kind of touching on the fact that implicitly, especially now, we definitely all know that the Federal Reserve is going to be the lender of last resort, and it's going to be a backstop for all these banks, no matter what situation they're in. And I'm talking about the large banks, right? Not really so much regionals. They've made it clear that, hey, if he dies, he dies. That's how they feel about regional banks. But when it comes to the commercial banks, your JP Morgans, your Bankers of Americas, although they try to, on the surface, look a lot more responsible with the lending than they actually are, they know that they're allowed to take a lot more, almost infinitely more risk than a regional bank, because they know no matter what, they're going to get bailed out by the Federal Reserve. If they become upside down on bonds, hey, they can't really operate at a loss, but the Federal Reserve can operate at a loss. And at the beginning of the pandemic, they were operating at a loss because they were buying bonds off of these banks and institutional balance sheets to basically shore up those banks so that way they don't go under in a tough time. Because during that time, shit would have been really, really bad. Talk about a depressionary cycle. It would have been really bad if we didn't have the Federal Reserve agree to essentially just backstop and just start buying all those bonds off of companies' balance sheets.
Yeah, just to sum it up, the economy runs off incentives. So if you're not being held accountable for an action or the lack thereof, why give a fuck? So like he said, if you know that you're going to get paid to get people to take out loans, and even if those people aren't qualified or even if it's not in their best interest, you're still going to get paid. And if everything blows up in your face, you're going to get bailed out. What reason do you have to not? All right, next point, spotting bubbles. All right, he talks about the 7 things that you can see to spot a bubble. First one, prices are high relative to traditional measures. Second, prices are discounting future rapid price appreciation from these high levels. Third one, broad bullish sentiment. Fourth one, purchases are being financed by high leverage. Fifth one, buyers have made exceptionally extended forward purchases, parentheses, built inventory, contracted for supplies, etc., to speculate or protect themselves against future price gains. 6, new buyers have entered the market. 7, stimulative monetary policy threatens to inflate the bubble even more, and tight policy causing its popping. So the first point, prices are high relative to traditional measures. So there is something called the mean, and that's why whenever you see me like do my technical analysis, I like my 200-day and my 62 EMA on there because the market always comes back to it. So the first point he's saying prices are high relative to traditional measures. When prices get really, really extended, it may be a good time to start taking some profits. Broad bullish sentiment. If everyone thinks the bull market's going to go on forever, you always hear people say, get greedy when others are fearful, fearful when others are greedy. When it's broad bullish sentiment, everyone's greedy, thinking everything's going to go. The smart money is probably start taking money off the table. And it's opposite when in crypto, when people think Bitcoin's going to zero, it's not going to come back, all these negative narratives, and the technology is still performing flawlessly like it has been since its inception. That's when you want to start using leverage and taking like crazy risk, not when everyone thinks you should.
Now, yeah, and that's actually the next point. Purchases are being made by essentially using leverage. And we just saw a little unwind, once again, going back to the Japan situation last week. And that was kind of a mini bubble within itself. That trade got a lot of attention over the past couple of years. And we saw that unwind. And I think that it's going to have more of a trickle effect than we thought. And I don't think that the deleveraging or global deleveraging is over at that point. So we're going to start to see all of those leverage positions start to unwind, or at least a good chunk of them start to unwind over the next few months here. So this next point, number 5, buyers have made exceptionally extended forward purchases, built inventory, contracted for suppliers to speculate or protect themselves against future price gains. So you can kind of look at that as analogous to the overbuilding that we saw in the single family and the multifamily, but I'll focus on the single family space over the past couple of years as well. So the reason why single family home new builds have still been able to perform relatively well in terms of the price not falling through the floor due to oversupply is because with new home sales, builders have a lot more control when it comes to putting those homes on the market or counting them as inventory, essentially. So a lot of the times they'll have homes that they're not necessarily built, but the plans are in place and they're being built, but that doesn't count as finished inventory, even though in some metrics they're counting them as inventory, just not finished inventory. And so you can kind of look at it like that as well, that we were entering into a housing bubble, which is why everyone was screaming that, oh, we're entering a housing bubble. But obviously, with housing, we've talked about this plenty of times on this channel. I don't think that it's going to do anything drastic one way or the other at this point. I think it's just middle of the road. We're going to have consistent price gains over the next couple of years. And I think, at this point, I've always said the best hedge against inflation is a 30-year mortgage. And we've been seeing that play out to a T. So, yeah, keep buying, guys. I don't even know why I said that, but.
Yeah, and then the last two, and that's the next one, new buyers have entered the market. So whenever you see a bubble, you probably say that, if something's in a bubble, it's probably at all-time highs. Like if a market goes here and we're in a bubble and it drops and it goes here, people normally consider a bubble when market reaches all-time highs and they think it's going to pop.
Right? I think one of the greatest examples of a bubble was 2017 Bitcoin. Like that was so to a T bubblicious, it doesn't make any sense. Like you sitting at dinner and your uncle like, hey, so I think about getting some of that Bitcoin. You got some of them Bitcoins? Like you knew at that point, like, oh shit, all right.
Yeah, so perfect example. Like whenever Bitcoin hits all-time highs, people say it's in a bubble. But like right now, it's under 70K. People not saying Bitcoin's in a bubble. They may think it's gonna come down, and it's just like when he's saying new buyers have to enter the market. For any market to see all-time highs, two things have to happen. You have to have an increase in demand, aka a new pool of buyers entering the market for the first time because historic demand isn't going to bring prices to new heights. And then you have to have a supply that can't meet that demand. And that's why Bitcoin goes on these rallies after the halvings, because the supply of Bitcoin gets cut in half. So even if the demand just stays the same, prices have to go up, right? And then the last point, stimulative monetary policy threatens to inflate the bubble even more, and tight policy causes its popping. That's pretty self-explanatory. Stimulative monetary policy is basically them either printing money or lowering interest rates. We already talked about the effect of lowering interest rates. It makes capital cheap, more people borrow, and a lot of times...
And also them rolling off their balance sheet, rolling assets off their balance sheet is a form of stimulation as well to the economy.
Yeah, and a lot of times once
most of the time, once interest rates are cheap, people use that money to buy assets. Like you saw what happened during the pandemic once interest rates were pretty much at zero and they were sending out stimulus checks. That's when we saw Bitcoin hit a new all-time high because people were taking their stimulus checks and borrowing money, the PPE loans and the EIDL loans, and they were taking them and they were putting them into Bitcoin and the stock market. And then everything kind of tumbled down in 2021 or 2022 and 2023. And just to hint on our other point, any kind of depression, recession, or any downward market period can be traced back to easy money by the Federal Reserve. They made it really, really easy for corporations and people to borrow money after the pandemic through the EIDL loans.
The choice
and
GDP
loans.
shot up 42% during that time.
Yeah, so it's just like people were using that. They were getting that money easy, and it caused a bubble. Like it was a huge corporate debt bubble because it was easy for corporations to get those loans because they were business loans for people's businesses who were suffering because of the pandemic.
Well, we're still in a corporate debt bubble.
Yeah.
Zombie companies, the reason why that we allow them to exist is the only reason that this corporate debt bubble will continue to be extended.
Yeah, and it's just like, just to give you guys a fun fact, I think we covered this in the Great Devaluation book review. 2008 was a result of people being able to borrow money for mortgages very easily, right? But this corporate debt bubble that we're in is due to corporations being able to borrow money very, very easily. And this corporate debt bubble that we're in is actually 5 times larger than the whole mortgage debacle that we experienced in 2008. Bless you. So guys, we're gonna put a bow on this one. We gotta go catch the sunset, and we have a event that we're doing today. So this is gonna be probably a 3-part book review series because we have like 6 pages of notes. And this book is a textbook, guys. It is long.
And it's Ray Dalio.
It's long and hard.
We didn't even touch on populism yet, so that means we got a long way to go.
Yeah. So if you got value, drop a like, drop a comment.
Don't forget to tell your auntie, too.
Tell your auntie, share with a friend, and we'll see y'all in the next one.